stock that is in focus today, and that is Persistent System, that is up in away 2.5% in trade. It's an earnings candidate, and it has posted very strong set of numbers. It is ahead of what ET now was penciling in. It has delivered 20th straight quarter of revenue growth, strong performance across all segments, and they have a large order win also that's accelerated in Q4. To weigh in on the numbers, then we are now joined by Sandeep Kalra, who's the CEO of Persistent System. Hi, Sandeep. Thank you so much for joining us. Good afternoon to you. Sandeep, very strong set of Q4 numbers coming from the company. What segments led to this growth, and especially in your BFSI space?
So if we look at the overall quarter, let me summarize the results for you, and then I'll go into the segmental growth part of it. So if we look at our Q4 FY25, we delivered revenues of 375.2 million. This is 4.2% sequential quarter and 20.7% year-on-year basis growth. Now, if we look at it from a segmental perspective, healthcare, life sciences, BFSI, and tech, all of these verticals grew. If I look at specifically for the quarter from a same quarter year-on-year perspective, healthcare, life sciences grew by 33.6%, banking, financial services by 26.6%, and software high-tech by 9.7% year-on-year. And if I look at a yearly growth rate, healthcare, life sciences was the vertical that grew for the company for full year at about 54%, BFSI 17.8%, and software high-tech 3.7%. So we are seeing an overall growth from a year-on-year basis. Within the quarter, the two verticals that led were BFSI and high-tech.
All right. Hi, Sandeep. Good to be speaking with you. This is Shrishti also joining in. But when I look at your numbers, then the company has delivered EBITDA margins of more than 15% after a long, long time. But the key question is that can we see these numbers sustaining in the coming quarters as well? And if yes, then what will be the levers to help this growth?
Clearly that our aspiration is to improve margins as we go along in our journey towards $2 billion. Our full year last year, as in FY24, was in the range of 14.4%. This year, we have delivered 14.7% on a full year basis. Our exit run rate for Q4 came in at 15.6%. This was on the back of disciplined execution. And as we go ahead, we are confident of maintaining the margins at an EBIT level within a narrow band. Within that, there are multiple levers that we have, whether it is managing our utilization at the same level, managing our subcon costs, and doing more offshoring of the larger deals that we have won, including the vendor consolidation that we have done that has led to some of these subcontractor kind of costs going up. If you look at our sales and marketing expenses, we have pretty much been at the same level in terms of our sales headcount for the last 1 year. And as we grow our revenues in the coming year, we are confident of containing our sales and marketing costs lesser than the overall revenue growth that we envisage coming in the year. So between these things and more offshoring, we are fairly confident we should be able to maintain our margins within a narrow band as far as our EBIT levels are concerned.
Right. Sandeep, also at a time when discretionary spending and the budgets are being delayed, how is the demand trend and the client confidence looking like?
If you look at the last 6 weeks to 8 weeks, there has been a slowdown. There has been a little bit of concern about the overall macro, given what is happening on the tariff front, the DOGE front, and so on in the US. We are hopeful that with time, this should ease. And at the same time, please keep in mind, IT services as an industry, and we as a company, we have proven multiple times over, whether it is revenue growth kind of an environment where discretionary spend is strong, or a cost containment kind of an environment where we help our customers manage their costs more effectively by using both offshoring as well as our technology platforms like Sasva, which is our AI-led platform to do faster, better kind of product engineering or application development maintenance while containing costs. So we are fairly confident. And even if you look at our wins over the last several quarters, many of them have been cost containment, vendor consolidation kind of deals. So we are fairly optimistic. The growth rates may taper here or there or increase, but we will deliver among the top quartile in the industry.
All right, but Sandeep, along with that, it's heartening to know that in this environment, the company has been adding large customers of over $5 million, like from 47 in number in December quarter. This number has gone up to 54. But how are the large customer acquisition trends looking like for Q1? Are there any large orders or the large customer additions already in pipeline that you're working with?
So we don't give forward-looking guidance, so I'll not comment on FY26 first quarter or thereabouts. But I would only point out to the fact that if you look at our customers, in the last 1 year, if I was to give you a comparison over the last 1 year, our 75 million plus customers increased from 2 to 4. Our 50 million customers increased from 3 to 4. Now, if you look at our category of 5 million that you talked about, in the last 1 year, that has moved from 40 to 55 customers. All of this bodes very well for us and also proves the point that we are capable and have consistently been gathering market share from our competition, whether it comes to mining in our existing accounts or getting newer prospects to become our customers.
Also, the company has stated in its press release that they are optimistic to reach $2 billion in annual revenue by by FY27. Are you on track for this figure to be achieved, despite the volatility seen in the markets?
Yeah, so if you look at our, compounded annual growth rate for the last 4 years, it's in the range of 24% or plus of that. If you look at where we are, we deliver $375 million for the last quarter. That gives us a run rate of $1.5 billion. So if we were to execute with discipline and a tad bit of inorganic built into it, we are fairly on the trajectory of achieving the aspirational goal of $2 billion. And if something goes here or there for a few quarters in the macro, we'll deal with it. And, we are talking of 2 years to reach our goal, and we are fairly confident of reaching there.
And lastly, what we note is that the company has been very vocal towards pivoting to the AI-related services. But help us understand, what are the important pivot plans that the company is working with? What are the big plans here and the expected revenue potential from these programs?
Yeah, so if you look at the AI side of it, there are two pivots we have been talking about: AI for technology and AI for business. Keeping it short, AI for technology is where we are working with people who are product companies, building the technology for enterprises. So think about the large hyperscalers, think about the other tech companies, which are, startups to larger companies bringing technology to market. There we are product engineering partners. We are helping them build their technology or build their connectors to be able to launch these technologies into the enterprise side. The second part of it is where we are building platforms like SASVA, which enable faster, percolation of technology, also developer productivity enhancement in the product companies, as well as the enterprise side in application development and maintenance. Last but not the least, we are working on AI for business, where we tackle horizontal use cases, whether it is contact center modernization, data modernization, plumbing the enterprise for GenAI use cases, and so on. And we have platforms and IP to enable both of these, and we are fairly confident of us being the leading technology services provider in this space.
All right. Thank you so much, Sandeep, for getting us all those details. Thank you so much for taking the time out and speaking with us on your earnings and also helping us with the way forward. So that was the management of Persistent Systems. Very strong commentary, as well as the earnings were actually good. The stock holding up to the gains of almost 2.5%. But taking a look at